Welcome to episode 1 of the ACCA Technical Edge show.
Glad to be here and really excited to dig into this one.
Yeah, so if you are listening to this right now, chances are you're an ACCA student, you've got exams coming up, and you are looking for that edge to really master the material.
Right. Specifically for Part C of the syllabus.
Exactly. Our mission today is to completely decode the world of internal controls and internal audit. We've got a whole stack of sources here, everything from your core study guides to the foundational 1999 Turnbull report, plus some real-world case studies.
And, I have to say, internal controls sounds incredibly dry on the surface.
Oh, totally.
I mean, it just conjures up images of, gray-suited managers with clipboards putting up endless bureaucratic roadblocks just to make your day harder.
Yeah, I used to think of it purely as corporate red tape. But reading through these sources, it hits you that internal controls are actually the secret nervous system of any successful business.
That's a great way to put it.
Without them, a company isn't just inefficient, it's basically flying blind into a storm.
Exactly. And understanding these concepts, well, it goes way beyond just memorizing a textbook to pass an exam. It's really about grasping how organizations survive in a deeply chaotic world.
So let's build this from the ground up. The sources keep pointing back to 1999 and that Turnbull report.
Right. The Turnbull report was a massive game changer. Before that, controls were often just an afterthought.
Just a locked door or a password.
Yeah, exactly. But Turnbull framed internal control as a huge collection of policies, processes, tasks, and crucially, behaviors.
Behaviors. I like that.
Yeah, and together they do three things. They facilitate effective operations, ensure quality reporting, and maintain compliance. But that word behaviors is the real pivot point.
Because a rule book is useless if the humans don't follow it.
Right. If the people in the building don't actively participate, the system fails.
But I do want to challenge the idea of facilitating effective operations, though. I mean, if you ask a floor worker, they usually view controls as the brakes.
Oh, absolutely. The bottleneck.
Yeah, the bottleneck that slows the whole company down when they're trying to move fast or innovate.
That friction is a very real perception. People feel like filling out an extra form or waiting for a signature just costs valuable time.
But I like to think of it like the brakes on a Formula One car.
Okay, I like where this is going.
Those carbon fiber brakes, they don't exist simply to stop the car. They actually exist so the driver has the absolute confidence to go incredibly fast.
Oh, that's brilliant.
Right. Because if you know your brakes are flawless, you can accelerate way longer down a straightaway and hit the brakes the very last millisecond. If you don't trust them, you have to crawl around the track.
I love that analogy. And honestly, the Turnbull report championed that exact positive philosophy. Properly applied controls add tangible value.
They aren't just preventing disaster.
Right. They do this by constantly measuring actual outcomes against original plans, so management can dynamically steer the business.
You can't optimize what you aren't measuring.
Exactly. But, and this is a massive caveat that surprises a lot of students, Turnbull clearly stated that there is no such thing as a perfect internal control system.
Wait, really? I mean, if a massive multinational has $1 billion for state-of-the-art security, AI, and elite auditors, why can't they build an impenetrable system?
Because organizations operate in a totally fluid, dynamic environment. The variables are infinite.
So the target is always moving.
Always. Just as one specific risk is neutralized, completely unpredictable new ones emerge. Think about sudden geopolitical shifts or, rapidly evolving cyber threats.
So a system built for yesterday's threat is blind to tomorrow's.
Precisely. Plus, human error, fatigue, and deliberate collusion will always exist.
Yeah.
So the ultimate goal isn't a 100% guarantee.
What is the goal then?
The goal is to provide what we call reasonable assurance that the organization's objectives will be met.
Reasonable assurance. Okay, for you listening, highlight that concept in your notes right now. You aren't building a fortress. You are designing an adaptable defense mechanism that gives confidence, while acknowledging risk can never be zero.
Spot on.
Which leads us to the core targets. If our goal is this reasonable assurance, what specific organizational objectives are we trying to hit?
Well, our sources break this down into 5 key objectives. To really get them, let's use a hypothetical company.
Okay, lay it on me.
Let's imagine a rapidly growing startup making high-end electric bicycles.
Nice. E-bikes.
The very first objective of internal control is the efficient conduct of business.
So keeping the F1 car moving smoothly.
Exactly. For the e-bike company, this means the assembly line runs smoothly, parts arrive just in time, and there are no crippling operational disruptions.
Makes sense. What's number two?
Second is safeguarding assets. And this isn't just about putting a heavy padlock on the warehouse so nobody steals the bikes.
It's digital too, right?
Yes, tangible and intangible. The proprietary battery designs, their customer database. A cyber breach that steals data is a massive failure of safeguarding assets.
Got it. And the third objective,
Preventing and detecting fraud and unlawful acts.
which I imagine gets harder as you grow.
Oh, exponentially.
Yeah.
In the garage days, it might just be petty cash theft. But as they scale globally, you're looking at ghost employees on the payroll, kickbacks with overseas suppliers. It gets complex.
Your controls have to evolve to catch all of that.
They absolutely do.
Okay, the fourth objective is ensuring the completeness and accuracy of financial records, which seems obvious. You can't produce accurate statements if the raw data is flawed.
Right. If the inventory system double counts every bicycle, the balance sheet is basically fiction.
And the fifth objective.
Timely preparation of those financial statements.
See, I've always found the emphasis on timely interesting. Like, if the data is 100% accurate, why does a delay of a few months matter so much?
Because a few months is an eternity in business.
I guess that's true.
Legally, you have strict deadlines with regulators.
Yeah.
Miss them, and you get massive fines or trading suspension.
Oh, wow. Yeah.
And internally, if management gets accurate data that is 6 months old, it's entirely useless for making strategic decisions today. They need a real-time dashboard.
Okay, so knowing those 5 objectives, efficiency, safeguarding assets, stopping fraud, accurate records, and timely reporting, who is actually on the hook for them.
Well, scale changes everything here. In a small sole trader business, the owner is on the shop floor.
They oversee every transaction personally.
Right. They manage controls through sheer physical presence. But as our e-bike company grows into a large limited company, specialization takes over. The shareholders can't see everything anymore.
So they hire people to look out for them.
Exactly. Under agency theory, the shareholders appoint a board of directors to act as their agents. Thus, the board assumes the ultimate responsibility for internal controls.
The buck stops with the board, and a huge part of their job is shaping what the literature calls the control environment.
Yes, the control environment.
Now, when I first read that, I thought it meant like HR putting up motivational integrity posters in the break room.
A lot of people make that exact mistake.
Just having pizza Fridays to boost morale or whatever.
Right, but it's actually the foundation for all the other components. It's the overall attitude, awareness, and actions of directors regarding the control system.
It's the tone at the top.
Exactly.
So if a company spends millions on the best compliant software and writes strict rules, but the CEO constantly overrides them for shady deals and mocks the compliance officers,
Then the software is completely useless. The control environment is toxic. Staff watch the CEO and realize the rules don't actually matter.
culture dictates behavior way better than a written manual.
Absolutely. If the board doesn't foster genuine ethical behavior, every technical control built on top of that will eventually crumble.
Okay, assuming the board has a strong control environment, the company still needs actual physical mechanisms to govern day-to-day work.
Right, the actual tools in the toolbox.
Our sources categorize these into a few distinct buckets. First is mandatory versus voluntary controls.
Mandatory being the non-negotiable external laws, right? Like health and safety on the factory floor.
Exactly, or emissions caps. Voluntary controls are internal best practices the company chooses to implement just to be better, even if no law requires it.
We also categorize them as discretionary versus non-discretionary.
Break that down for me.
A non-discretionary control is absolute. If safety requires a harness above 10 feet, there is no wiggle room. You wear it.
And discretionary.
It relies on human judgment. A manager might have the discretion to waive a late fee for a loyal customer based on context.
The most fascinating one for me is manual versus automated controls, especially with tech taking over.
Oh, definitely.
I read an example about credit rating systems that really clicked for me, and automated control is just hard-coded. Imagine someone applies for financing for one of our expensive e-bikes.
Right.
The system pulls their score. Above 750, instant approval. Below 500, instant decline. No human is involved.
But modern systems usually combine the two, right? They handle the extremes but flag the gray areas.
Yes. If the score is exactly 620, the automated system stops. It sends it to a pending folder.
And that's where the manual control takes over.
Exactly. A human credit manager opens the file, reviews the nuances of their income, and uses manual discretion to approve or decline.
Within tech, we also have to distinguish between general IT controls and application controls.
Right.
General controls create the secure environment. physical security for servers, backup generators, company-wide passwords.
So it's just the basic infrastructure.
Yeah, application controls are the specific automated checks inside a single piece of software.
Like what?
Like if a clerk tries to input February 30th as a date, an application control instantly throws an error message.
Yeah.
General keeps the computer on. Application ensures the math is right.
Got it. Now, getting down to the granular, everyday level, what do these look like for an employee?
One of the biggest is authorization.
Ah, spending limits.
Right. A junior manager at our e-bike company needs office supplies. They can independently approve up to $500. At a $2,000 laptop.
The system physically locks them out.
Exactly. They have to route it to a senior director. It limits financial exposure.
And an equally critical procedure is the segregation of duties.
This one is huge. The principle is that no single individual should have absolute control over a whole transaction from start to finish.
The classic textbook example is the corporate post room, right? It perfectly illustrates fraud prevention.
Walk us through it.
Well, if a company receives cash in the mail, the person who opens the envelopes cannot be the same person who records those payments in the accounting ledger.
Because if they're the same person, they could just slip a $100 bill in their pocket and purposefully fail to record it.
The cash vanishes, the books look fine, and the theft is totally invisible.
But by segregating duties, the mail clerk hands the cash to a cashier, and a separate clerk records the transaction.
So to steal now, they'd have to actively collude, form a conspiracy together.
Which is much harder and riskier to pull off. And this principle scales all the way to the top. It's why corporate governance dictates splitting the CEO and chairman roles.
Ah, because the CEO runs the daily ops, and the chairman leads the board that scrutinizes the CEO.
Exactly. If one person holds both titles, they are policing themselves. It's a dangerous concentration of power.
So all of these authorization, segregation of duties, physical controls, they weave together into a broader concept called internal check.
Yes. Internal check is the continuous, day-to-day layout of complementary procedures.
So the work of one employee naturally serves as a check on another, just by doing their normal jobs.
It creates an operational tapestry where errors or fraud are quickly caught by the next person in the chain.
Which naturally makes me wonder, if a company has a great culture, automated systems, segregated duties, and a seamless internal check, why do they need an internal audit team?
That's a super common question.
Yeah.
People think it's redundant.
Doesn't it just duplicate what management is already doing?
No, and the critical difference is independence. Management designs and builds the controls. Internal audit is an independent appraisal function tasked with evaluating if those controls actually work.
Think of a high-end restaurant. The internal controls are the daily routines. Chefs washing hands, logging fridge temperatures every hour. That's the internal check.
And the internal audit is?
The city health inspector. The inspector doesn't cook. They walk in unannounced, specifically to evaluate if the chefs are actually following their own temperature logs.
That is a perfect analogy. The value of that inspector is their objectivity. Internal auditors must operate completely free from management bias.
Because if an auditor reports to the CFO and the CFO is cooking the books,
The auditor's paralyzed. They can't objectively report their own boss.
Hmm.
To stay independent, the head of internal audit must report directly to the board or an independent audit committee.
Okay, so when this independent team starts looking under the hood, what are their specific targets?
They review accounting systems, monitor legal compliance, and verify asset safety. But a massive part of their mandate is evaluating the 3 E's.
Economy, efficiency, and effectiveness.
You got it.
Let's apply that to the e-bike company. Economy is input cost. Are we buying raw aluminum at the best price without sacrificing quality?
Yes. And efficiency is the process. Are we maximizing bikes produced per hour with the resources we have?
And effectiveness is the final outcome. Even with cheap aluminum and fast production, are we actually selling bikes and hitting our market share goals?
Exactly. Internal audit evaluates that entire spectrum. And Turnbull actually mandated that listed public companies without an internal audit function must formally review the need for one, at least annually.
They can't just ignore it. They have to justify to shareholders why they don't have one.
Right. Small companies might not justify the cost, but as you grow or expand internationally, the cost-benefit analysis shifts.
Especially if management notices weird stuff happening.
Oh, definitely. If inventory mysteriously shrinks or operational costs suddenly spike, the need for an independent audit becomes undeniable.
So the board approves the budget, the audit team is in the building. How do they actually run these tests? Our sources outline several distinct types of audits.
It depends on what they're evaluating. Often they start with operational audits. This looks at the efficiency and effectiveness of a specific department.
Like embedding in procurement to see if workflows are too convoluted.
Exactly. Next, they run systems audits to look at the underlying machinery. And this is crucial for the exam systems audits are broken down into compliance tests and substantive tests.
I used to think a substantive test just meant it was like testing something more important.
A lot of people do. But it's more mechanical. A compliance test verifies whether the controls are being applied properly.
So back to the restaurant, the compliance test is the auditor observing if the chefs are actually filling out the log on the fridge door.
Yes, testing the process itself. A substantive test, conversely, is verifying the accuracy of the actual figures to hunt for errors.
Oh, I see.
A substantive test is the auditor pulling out their own thermometer, walking into the fridge, and checking the meat to see if it matches the number written on the log.
Compliance tests the control. Substantive tests the truth of the data.
Spot on. Beyond that, auditors run transactions or probity audits. These are targeted deep dives hunting for fraud and criminal behavior.
But how do they hunt for fraud in a massive corporation? It's not like looking for a burglar in a mask.
It's all about data analysis now. An auditor might run data matching software to compare employee bank account numbers against approved external vendor accounts.
Ooh, wow.
Yeah, if an employee's personal bank account perfectly matches a vendor supplying office equipment, you've just uncovered a massive red flag for a ghost supplier fraud scheme.
That is incredible. And finally, we have social audits. Decades ago, auditors only cared about the ledger. Now, they examine corporate governance, transparency, and societal impact.
Because a failure in social responsibility can destroy a company overnight.
Right.
A social audit might examine carbon footprints or labor conditions deep in an overseas supply chain. If they find child labor, that's a catastrophic risk to the stock price.
Controlling that risk is just as vital as controlling the petty cash box.
Absolutely.
Well, we have covered a massive amount of ground today, from dismantling the myth of perfect control to embracing reasonable assurance.
We looked at the control environment, segregation of duties, internal checks.
And the independent watchdogs running the 3 E's and compliance tests.
It really is a deeply interconnected ecosystem. Audit can't function without controls to evaluate, and controls decay without audit scrutiny.
Before we wrap up, we want to leave you with a final provocative thought that goes beyond the syllabus.
Something for the future.
Exactly. We discussed manual controls being replaced by automation. Soon, AI will be able to handle nearly all continuous internal checks, matching millions of data points at light speed, predicting fraud before it happens.
And if AI does all the heavy lifting of the mechanical processes, it raises a really profound question.
What's that?
Will the human control environment, the culture, the ethics, the tone set by the board, become the only true defense an organization has left against catastrophic failure?
If algorithms enforce the rules, humans must supply the integrity.
It's a dynamic you will absolutely have to navigate in your future careers.
Thank you for listening.